Janard Trust here. In this video, I'm going to go over some ETF portfolios that will help you get very, very rich. But before I break those down, please take a moment right now to hit that subscribe button and that like button because y'all know y'all love me, right? I'm giving you this information. You're going to enjoy it. Hit that subscribe button and the like button for the algorithm. So several ETF portfolios have been suggested for potentially high returns in 2025. Though it's important to note that no investment strategy guarantees getting rich. Wink, wink. Here are some popular ETF combinations for aggressive growth. You have the high growth portfolio, 60 to 70% in Vanguard S&P 500 ETF, the VOO, for broad market exposure, 20% in a growth focused ETF like Vanguard Growth ETF, VUG, or Vanguard Information Technology ETF, VGT. You have 10 to 20% in a leverage ETF like ProShares Ultra Pro QQQ for high risk, high reward potential. You have the diversified growth portfolio, Schwab US Small Cap ETF for exposure to smaller companies with high growth potential. You have the SPDR portfolio, S&P 400 Mid Cap ETF to capture mid-sized company growth. You have iShares Core S&P Total US Stock Market ETF for broad market coverage. Then sector-focused portfolio, you have the YieldMax NVDA Option Income Strategy ETF for exposure to NVIDIA's potential growth. Invesco QQQ Trust for tech-heavy allocation with some diversification. You have the Range Nuclear Renaissance Index ETF to capitalize on growing nuclear power demand. Balanced growth and income portfolio, so Vanguard Value ETF for exposure to value stocks that may outperform in 2025. You have the Financial Select Sector SPDR Fund to benefit from potential strong performance in the financial sector. You have the Wisdom Tree US Quality Dividend Growth ETF for income and growth potential. Now, let's focus a little bit on iShares 20 Plus, right? Now, how has the performance of iShares 20 Plus Year Treasury Bond ETF been doing recently? Because I think we should focus on it a little bit because I see potential here. So the performance of the iShares 20 Plus Year Treasury Bond ETF has been negative recently. However, the ETF has experienced a decline of 1.17779% today, with the price dropping by $1.05 to 88. So over the past year, TLT has shown poor performance. The total return over the last 12 months is minus 7.84%. The market price return is slightly worse at minus 8.06% for the same year period. Year to date, performance is also negative with a total return of minus 7.84%. When, hey, get them low, right? So if you're looking for longer term performance, the 3-year total return is minus 34.91%. The 5-year total return is minus 26.90%. The 10-year total return is minus 10.66%. Now, let's switch gears. How does the Vanguard Value ETF, VTV, compare to the other value ETFs? So the Vanguard Value ETF, VTV, compares favorably to other value ETFs in several aspects. You have performance. VTV has shown strong performance recently with a 4.77% year-to-date return. Over the past 10 years, it has delivered an annualized return of 10.39%. The low expense ratio, VTV has an expense ratio of 0.04%, which is considered very low compared to the broader market average of 0.3% to 0.9%. This makes it a cost-effective option for investors seeking value exposure. You have the dividend yield. VTV offers a competitive dividend yield of 2.21% for the trailing 12 months, which is higher than some other popular ETFs like the VOO at 1.20%. You have the risk-adjusted performance. VTV has a Sharpe ratio of 1.90, indicating a good balance between risk and return. You have the lower volatility compared to some broader market ETFs like VOO. VTV has shown lower volatility, 2.78% versus 3.13% for VOO, suggesting it may be less risky. You have the diversification when compared to other large cap ETFs like VV, Vanguard, right, large cap ETF. VTV offers a different exposure focused on value stocks, which can be beneficial for portfolio diversification, ETF portfolios mistakes. ETF investors often make several common mistakes that can hinder their investment performance. So you got to be on top of your game. Now, here are some key mistakes to avoid when investing in ETF portfolios. You have over diversification. Holding too many ETFs, which is basically more than 3 or 4, can lead to unnecessary complexity and potential overlap in holdings. A well-diversified portfolio can be achieved with just a few broad-based ETFs. Now, frequent trading is the next one, right? Constantly changing ETFs disrupts compounding and generates capital gains taxes, potentially reducing long-term returns. It's better to adopt a buy and hold strategy and avoid timing the market. Ignoring cost is next. Failing to consider expense ratios, trading commissions, and other fees can significantly impact returns over time. Look for low-cost ETFs and brokers offering commission-free trading to minimize expenses. Now, there's also the lack of proper diversification. So while holding multiple ETFs doesn't guarantee diversification, it's crucial to spread investments across different asset classes, sectors, and geographies. So this helps manage risk during market downturns. Using leveraged ETFs inappropriately is another one, right? Leveraged ETFs are not suitable for most investors due to their amplified risks and potential for significant losses. These should only be used by experienced investors with a clear understanding of the risks involved. Okay, so that is what I have for you today. Take a moment right now. If you gained value from this video, hit that subscribe button and the like button. If you gained value, if you got what you came here for and you're happy, hit that subscribe button and the like button. Also, let me know your opinion in the comment section below. So I appreciate your viewership. See you on the next video.